Ladies and gentlemen, good day and welcome to Arvind SmartSpaces Limited Q4 and FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Smith Shah from Adfactors IR. Thank you, and over to you, sir.
Yeah, thank you, Vivian. Good evening, everyone, and thank you for joining us on the Q4 FY23 results conference call of Arvind SmartSpaces Limited. We have with us today on the call Mr. Kamal Singhal, Managing Director and CEO, Mr. Ankit Jain, Chief Financial Officer, Mr. Avinash Suresh, Chief Operating Officer, Mr. Prakash Makwana, Company Secretary, and Mr. Vikram Rajput, Head Investor Relations. Please note that a copy of disclosure is available on the investor section of the website of Arvind SmartSpaces Limited, as well as on the stock exchange. Please do note that anything said on this call which reflects the outlook towards the future, which could be constituted as a forward-looking statement, must be reviewed in conjunction with the risk that the company faces. I would now like to hand the call over to Mr. Kamal Singhal for his opening remarks. Over to you, sir.
Thank you. Thank you for your introduction. A very good afternoon to everybody, and a very warm welcome to everyone present on this call. Thank you for joining us today to discuss the operating and financial performance of Arvind SmartSpaces for the fourth quarter and full year ending 31st March 2023. I would like to begin by sharing my thoughts on real estate environment and broad highlights of the quarter. We can then look forward to taking your suggestions and questions. India, as we know, has now become the most populous country in the world. Its urban population is also, non-urban population is also one of the largest in the world now. This population obviously is moving towards city in a very, very big and quick way, making India the fastest urbanizing country in the world and humankind's history. This indicates that the market for urban real estate will keep growing at a pace which possibly has never been seen. Even as this real estate market is becoming larger and larger, we see that there is a huge scope for organized builders to contribute to this demand and supply, of course, wherein the change environment post-RERA and GST has meant that the small and unorganized players are finding it difficult to survive under the new regime, regulations, municipal compliances, etc. And there is a renewed opportunity for the organized players in that sense. This very big churn which is happening in the industry, and we've been talking about it in the last few calls all the time, has resulted into one of the widest gap between what market needs and demands and what is the kind of supply in terms of quality, in terms of quantity, etc., coming from these more qualified, quote-unquote, competent and organized players in the industry. And this unique situation is giving us an opportunity at Arvind SmartSpaces. We see this as a big opportunity for us and people like us and companies like us and businesses like us, where the gap between these two things has been increasing at a very fast pace, and this represents a huge opportunity to fulfill for players like us. At Arvind SmartSpaces, we are differentiated in product, we are differentiated in positioning, and we also feel that we are differentiated in perspective. We not only do different designs, we not only design properties very differently, we also think a little differently. The result of this holistic mindset is the ability to maximize value on every square feet of land that we consume and we use. We represent coming together of a company that is basically very conservative, but very, very audacious when it comes to creativity and designs. We have been talking about it in the past. We are trying to build a company which is, despite being a very, very capital-intensive business that we are all engaged in, we are building a company with very, very light balance sheet comparatively, with no debt at this point in time as we speak, and very clearly focused on a business which is very profitable, but at a relatively small balance sheet size. We are operating in a very competitive margin environment, but at the same time, we are optimizing and generating a very healthy return on equity, the way our business model is structured and the way we are trying to conduct our balance sheet, business and the cash flows. Coming to the operational performance, we are delighted to inform that the company has recorded the highest ever annual booking of rupees 802 crores, which represents a growth of 33% over FY22. For the first time, number of units sold also crossed 1,000 unit milestone annually. Brand Arvind continues to resonate strongly with home buyers across Ahmedabad, Bangalore and Gandhinagar markets. This is evident from the stellar performance of the new launches, including Fruits of Life, Forester 5, Greatlands, etc., which contributed to more than 56% of our total booking for the year. From a quarterly perspective, we had the strongest ever quarter Q4, bookings at 244 crores, second consecutive quarter with a sales value of over 200 crores that we achieved in the last 6 months. Our Bangalore presence has strengthened further, contributing 58% to the total annual booking. Both the phases of Greatlands have received overwhelming response from customers. Bangalore region is shaping up very well, and we expect it to get stronger in the coming years with increased launches and business development activities. Both FY23 and Q4 collections also were the highest ever in company's history, a result of efficient execution of various processes focused on sales, registrations, construction, deliveries, etc. And strong construction and profitability has also resulted in operating cash flows of more than 200 crores for the year. Moving on from operational update to the financial highlights, FY23 we reported a revenue of 256 crores, a similar number to the FY22, EBITDA at 49 crores and PAT at 26 crores, a growth of just about 2%. In Q4 we reported a revenue of 93 crores, EBITDA at 20 crores and PAT at 9 crores. Our balance sheet position remains very strong. Despite increased investment in business development activities, our net debt remained negative at 30 crores on account of significantly increased internal accruals. As I just mentioned, we've had 200 crore rupees of operating cash coming from the business itself in the year as a whole. As a company, the focus always remains on shareholders' value creation. We are happy to share that the board of directors recommended a final dividend of rupees 1.65 per equity share, and in addition to that, a one-time special dividend of rupees 1.65 per share once again, totaling to a total dividend of 3.3 rupees per equity share of face value of 10 rupees each. The momentum in the Indian housing market continues with the rise in residential sales, declining inventory levels and appreciation in capital values across major cities. Going forward, we are set to expand our portfolio of projects with several launches lined up across a range of micro markets in Ahmedabad, Bangalore, etc. Our investments of rupees 1,000 crore is very much on track, and we look forward towards its deployment in business development activities in the coming quarters. FY24 is expected to be a year of new launches, project additions and bigger milestones for ASL. We are set to scale up faster while maintaining our financial discipline. With this, this is about the broad environment that I wanted to talk about. Maybe now is the time that we could take questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Kindly press star 1 to ask a question. The first question is from the line of Bajrang Bafna from Sunidhi Securities. Kindly proceed.
Yeah, Congratulations for good set of numbers and achieving the guidance that the management has given for FY23. So sir, broadly if you could guide us what sort of launches that we are going to witness in the coming 1 or 2 quarters. The Sarjapur and all that we talked about in the last call. So what is the status and how are we seeing, the launches of those 4 or 5 projects which are lined up? What is the progress on that and what sort of, scenario which is existing, and is there any change on the ground level? Because hopefully, the indications from the debt markets are that we have peaked out in terms of interest rates, and as we move forward, we will see the rates either to stabilize here or to come down. So what is the ground level, indications on that will be really helpful. These are the questions from my side, sir. Thank you.
Sure. Thanks, Baljan. 2-3 parts of your question. Let me address the first one first, which is regarding the new launches. As I just mentioned in my address, the investment cycle that we overtook a few months back, which constitutes a big amount of proportion coming from HDFC platform is truly underway. As we speak, a very significant portion, or rather most of it, has already been now committed, in the sense of, when I say commitment, it basically means projects are identified, commercially negotiations are over, and possibly you would have also paid some amount of money to lock the deal. But then the last phase of actually announcing and assuming that the project is now taken and is underway is to complete the due diligence process, which is happening for various projects that we already kind of semi-finalized in that sense. So that's truly on, and we'll keep coming back to all of you and tell you individual projects as and when they keep maturing to that extent and that level. Having said that, while forecasting exact launches might be a little difficult thing, because timelines could always go a little here and there. But broadly speaking, we are targeting to launch projects with a top line potential of around 2,000 crores, a little less than that, within the next 3 to 6 months' time. So that's the target we have in mind. But that does not mean that that is what is the total of our current investment. Current investment cycle involves 1,000 crore rupees to be invested, which would give, as we guided earlier, a top line of around 4,000 to 5,000 crores. Out of this project pipeline that we are doing and executing right now, we are hoping that 40 to 50% of that should be coming into launch in next 6 months of time, so to say, within this year. So that's on the launches. Next thing that you asked was about markets and factors like interest rate, etc., etc. So as we speak, we keep hearing some of the headwinds in the form of interest rates and, the tech companies not doing that great overseas and in India, etc., etc. However, on ground, we have been fairly comfortable thus far. We have launched some of the most successful projects in the last few months, and velocities have been way better than what we would have anticipated even in a normal situation. So while on one hand we are all hearing news which should all be making us more cautious on the market side, but on the ground we've felt there's a decent amount of buoyancy. Maybe it's a result of product, maybe it's a traction that the brand is getting, maybe it's to do with the market which still is healthy, maybe it's about the product mix that we are trying to execute and the customer preferences, etc. But end of the day, it's doing good at this point in time. Interest rates also, as you very rightly mentioned, is a headwind, but we don't think that it has reached a point where we should be starting to worry too much. All these sectors give us enough food for thought, where we have alternative strategies and we have our socks pulled up to take up higher challenges. That's how we are taking it and keeping ourselves a little more cautious as compared to what we were 6 months back, 1 year back. But let's see how it pans out from here onwards. So far, so good. And we are hopeful that, interest rates in that sense are very close to having peaked out. We don't expect interest rates to go very dramatically up from where they are today, and hence possibly we are seeing the peak or very near peak when it comes to interest rates in India. Rupee has been very stable, why we say so has two reasons. Rupee has been pretty stable, especially if you were to compare with our peers across the globe. Possibly India is one of the better performing economies in terms of monetary, fiscal discipline, etc. And hence the currency is fairly stable. That means inflation is not expected to be going out of any reasonable limits, and hence prices to go up should not be the case. In fact, this is also kind of validated by the fact that most of the commodity prices is stabilized. Last 6 months have seen effective drop on a weighted average basis in terms of the broad basket of materials that our industry consumes. To that extent, the cost increase, the price increase pressures are low, inflation pressures are low, and hence we believe that interest rates should not be very dramatically different from where they are. But we are also not sure at the same time about interest rates going down in very near future. So either way, this is pretty stable at this point. Your other part was, I think we've covered most of the issues. Demand side we just touched, interest side we just touched, and we have also touched about the launches that you asked.
Thank you, sir. Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Ritik Sheth from One Up Financial. Kindly proceed.
Hi, good evening, sir. And firstly, sir, congratulations on an excellent execution over the last 4 to 5 years, from 200 crore pre-sales 4-5 years ago to 800 crores. Congratulations on that, sir, to the entire team. Hello.
Thank you.
Yeah. Sir, I have a couple of questions, mainly linked to the cash flow and the BD. Sir, in FY23, we have done approximately 200 crores of operating cash flow, as you mentioned in one of the slides. So, with FY24, with a strong launch pipeline, you mentioned 2,000 crores in next 3 to 6 months, and our existing projects are also doing reasonably well. So, would it be fair to assume that this cash flow will only increase further, and the money which we have to invest for this 2,000 crores of projects incremental that we are going to acquire, would it be more or less internally funded? Would that be a fair assumption for FY24?
Yeah, broadly, your conclusions and interpretation is correct. We did create a OCF of around 200 crores, little more than 200 crores in the financial year 23. And going by the fact that the recent projects that we launched have gone quite successful, and they are horizontal in nature, which tend to give us quicker cash flows, at least in the context of overall cash flows to be received for the project, and also in the context of proportionate amount of expenditure that we have to increase, which means that the net cash flows after expenditures into the project are healthy. That gives us confidence that this number of 200 crores should only be improved in the year 24. That's one. And obviously, this and more cash flows which are internally generated will go into investment cycle. But if you were to see the year as a whole, obviously the investment plan is bigger than the internal approvals that we are talking about here. It includes the unused component of platform with HDFC, and it has a component of possible debt that we can take. Right now we are negative, but negative is not a great idea in the long term. So we need to have reasonable amount of leveraging coming back into the balance sheet to create more value. Of course, we will be will remain very, very conservative, but the idea is not to remain negative on that. So internal accruals, debt to a very limited extent, and HDFC platform. These three things have been happening in the last 1 year. We've done quite a bit of this through all these three, at least two routes. We haven't really taken debt in that sense. But going forward, all these three will be getting exhausted, and hence the investment will comprise of all these three components.
Right. So just further on this, we have spent approximately 310 crores in FY23 for business development. So what kind of figure are we looking at for FY24, if you have something in mind, and what kind of GDV that will be getting on?
Yeah. So as I said, approximately 1,000 crore or thereabouts will go further within this year on BD activities.
Okay.
And that's what we have. As I said, we are nearing commitments, and that's the commitment that we are talking about. Broadly, that is what will happen in terms of new investments. On GDVs, I said we normally are at a proportion of 4 to 5 times the investments. So GDV should be more like a 4 to 5,000 crores. In our case, GDVs are comparatively lower because we are doing more horizontal projects. But in terms of the amount of EBITDA, amount of PAT, amount of cash flows that it generates, that will be equivalent or rather better than the normal GDVs, which should more be in the region of 5 to 6,000 crores of GDV happening from a 1,000 crore investment. So in simpler words, for everybody's easier understanding, we will definitely target to have margins, PAT, EBITDAs, etc., equivalent to or more than what we would have done from a GDV of 5,000 crores, 6,000 crores, by having a GDV of maybe more like a 4,000 crores in the same amount of investment. That's the product mix that we're talking about.
Oh, okay. So just to clarify this, 1,000 crores to be invested in FY24 for acquiring new projects, and this will be funded from internal accruals, HDFC platform, and if required, we will be levering up the balance sheet.
Correct. Yes.
Right. Okay. And sir, just one question on the bookkeeping. On the balance sheet, there is some 100 odd crores of debt, and we mention every time that interest-bearing debt. So if you can just explain, what is this interest-bearing debt and the balance sheet debt that we have reported?
Sure. I'll ask my colleague Ankit to address this question specifically.
Sure. Hi, Ritik. So balance sheet do not net off the debt and the investment. Investment is reported separately and debt is reported separately. Having said that, the balance sheet debt comprises of the OCD which we are issuing to HDFC, for which we have given a note in the investor presentation that approximately around 90 crores worth of OCD has been already issued to HDFC, which is outstanding and has not been reported while reporting the net debt, because we see that HDFC platform money is more related to the risk and reward which is being shared with the platform.
Okay, got it. Right. Okay. Sir, I have some few other questions. I'll get back in the queue. Thank you, and all the best.
Thank you. As a reminder to participants, kindly press star 1 to ask a question. The next question is from the line of Alpesh Thakkar from Antique Stock Broking. Kindly proceed.
Thank you for taking my questions, and congratulations for a very good set of numbers. So my first question is mostly on the industry front. So is it players like Mahindra, Sanjay Koteparty increasing their focus on redevelopment in Mumbai? Shouldn't a brand like Arvind also capitalize on this opportunity, and it will also give us our first entry into Mumbai in a easier way? So any thoughts on that?
Yeah, you're very right. We have kind of discussed this in the past also, that after Ahmedabad and Bangalore, we see Mumbai, outskirts of Mumbai rather, which is MMR, and Pune is our next geography. And accordingly, we have kind of deployed resources and efforts there in BD. some sort of activity has already taken some amount of shape there. Very hectic kind of efforts are being taken or put in. We are hopeful that we should be doing something there in very near future. Although in the beginning it might not be great in the sense of proportion of overall sales coming into our books from this market, but definitely this is a focus area, and dedicated resources are now in place from ground to see if we can make some sense out of one or two projects in these two markets. So clearly a focus area. We want to do a few things. Efforts are on, and we are a little conservative. But having said that, as you are aware, we've done one project already. It's almost about completed in Pune. So we know that micro market. We've learned our lessons. We've understood the market in more detail by going through this drill, and hence now feeling much more confident about doing it. Now it's a question of finding the right project with the right mix of profitability, sustainability, doability, size, etc., and we're taking up such projects. So you might end up hearing us soon.
Okay, thank you. And just to deep dive into this one, so is it fair to assume that, this 1,000 crore of, capital deployment that we are about to do in this year, that will have the portion, a few of the deals in Pune and MMR also on?
Yeah, so when it comes to BD per se, from the point of view of value, it's one bundle. So we are not keeping separate bundles for separate markets. All in all, we are intending to spend 1,000 odd crores, that's for sure. And to a certain extent, on one or two projects, some money should be diverted towards MMR and Pune markets as well.
Okay. Thanks a lot. And that's it from my side. All the best.
Thank you. For questions, kindly press *1. The next question is from the line of Rishikesh Oza from RoboCap. Kindly proceed.
Hi, sir. Thank you for the opportunity. So I wanted to reconcile the estimated operating cash flow.
Mr. Oza, we are not able to hear you clearly.
Am I audible now?
Yeah, this is better, sir. Kindly proceed.
Okay. So in our estimated operating cash flow table, we have said the 1,582 crore number of estimated cash flow. We say this is at the EBITDA level, at the EBITDA for the company level. Now, if we compare this with what earlier management had indicated that they wish to maintain around 22 to 25% of EBITDA margins, but if we compare this 1,582 number with the receivables plus the estimated value of inventory, the number is actually, way above 25%. So, can you help me get, reconcile this, or am I missing out any expense that is not there in the operating cash flow?
See, I would like to clarify that the estimated operating cash flow which has been reported is based on the future cash flow which we will be receiving from the existing bookings which are pending to be received. Secondly, from the inventory which will get sold, and after netting of the corporate overheads and of course the cost of the project. The cost of the project includes landlord share as well. So the operating cash flow which is estimated is not the EBITDA margin. It is at an operating level, but it is not that EBITDA is expected on a 6,400 crore base, the EBITDA is expected at 1,600 crore. That is not the interpretation.
So these two numbers in a way are disjointed. At any point in time, they might not match up to the 25%, but if you were to match up this number with whatever we've achieved in the last few quarters and few quarters going forward and add up everything, then this will all add up to 25% for sure. But this is a snapshot which has two different numbers which are disconnected, and this 1,500 basically is the money left over by paying up for all the lands, whichever is the outstanding amount towards the land, the landlord share in joint development agreements, and all the development expenditure left over now from here onwards, irrespective of the sales level, etc., and the corporate overheads. So it's a little disjointed number, and hence calculating percentage based on 1,500 crores to any number like top line or total money to be spent, etc., will not be correct.
Okay. And also, sir, at the start you mentioned that in 3 to 6 months they will be launching around potential of 2,000 crores. So, like, what will...
Mr. Oza, sorry to interrupt, sir. It's disturbing again on the line.
Is it better?
Yeah, you can continue. Let's try it out. Yeah.
So, my question is 2,000 crores of top-line potential project that you are that is launched.
I'm sorry, sir. Mr. Oza, we are not able to hear you.
Okay, so no problem.
Yeah, now it's better, sir.
Okay. Try again. So the 2,000 crores of top-line potential project that you said you will be launching in like 3 to 6 months. So what is our share in that?
Yeah, so the project-wise detail has been already been mentioned in the presentation. For example, Sarjapur Road project, which is a JD project, where the top-line potential is close to 670 odd crores. There our revenue share is 65%, number one. There is a project under the HDFC platform, which is a Dole Road project, where the top-line potential is close to 400 crores, right? So all the projects have been mentioned and detailed with respect to our share.
But as far as books of accounts are concerned and the gross margins are concerned, this entire 2,000 crore top line on a weighted average basis on the margin side will come and get reflected into our books of account only. So it's not that these numbers are going to be distributed between two balance sheets. They are all going to be coming in, resting in within our P&L and balance sheet.
Okay. Okay. Got it. Thank you.
Thank you. Participants, to ask a question, kindly press star 1. The next question is from the line of Chaitanya Shah from Silverlight Capital. Kindly proceed.
Hi, good evening. My question is, continuing from the previous participant question on the cash flow. Now, pardon me for my understanding. I just wanted to understand the 1,600 cash flow that you report. As a financial investor, how do I use this 1,600 crore number, to arrive at a valuation of the company? Because I got a little confused between when you said, because the presentation mentioned that this is the EBITDA level, and you said that there might be a mismatch. So if you could just give a little bit more detail in terms of what this actual cash flow is, and as an investor, what should I be expecting from this cash flow in terms of how it's going to come and how do I use it to value the company?
Chaitanya, as a policy, whatever information we are giving and we talk about, etc., is not about valuation of the company. Of course, valuation depends upon so many other factors and information here and other places. So that's a very difficult question really to ask and answer from our point of view. But what we can help you with is to say that this 1,500 crores represent the status of current projects already launched and the pipeline already being there on a firm basis. There are expenditures to be incurred and there are some incomes to be brought in, cash flows to be brought in. Netting off of everything, whatever is happening currently, without considering for the investment cycle that we just talked about, broadly speaking and maturity speaking, this is a snapshot of what is happening right now, excluding the projects which are not forming part of the mix of the projects which are detailed in the presentation, adding up to this 1,500 crores. So it's just one number which gives you a snapshot of current. Then, there are projects being undertaken, investment cycle being undertaken, etc., etc. These are the relevant numbers per se. But valuation will be something which is an independent issue and needs to be addressed accordingly.
Adding to as one more clarification statement, this represents a free cash flow which will accrue to us and which represents only our share of numbers. For example, if there is a HDFC share, it does not include that HDFC.
Any distribution outside is not part of this. This is our share from whatever we are doing based on the projects which are already in the market, launched and acquired. It does not represent the investment cycle of the plan, which has not still got concluded, so to say.
All right. Thank you so much for that. Regarding the Bangalore and the Ahmedabad market, could you help me with the value and volume growth that would have happened in this market, because we clearly had a pretty strong growth in our pre-sales.
So you're asking about the proportion of sales that happened?
No, I'm asking about the market in general.
Market in general. Okay.
Yeah.
So I think both the markets are doing fairly strong, despite the challenges that a city like Bangalore is assumed to be facing. I think there is enough and more traction coming from that market. If Bangalore is strong on IT, of course, traditionally, but it's equally strong on services, which are traditional services, on manufacturing and other services. So Bangalore is a mix of quite a few sectors which are going strong per se. And even if a sector like IT was to go a little slow, there are quite a few other triggers as well. So we are quite hopeful and we are quite buoyant about Bangalore as a market. In fact, a very significant proportion. Can you help me with this exact number out of 800 crores that we did? What is the proportion exactly?
58% is about.
So almost like 60% has come from Bangalore in the year which ended in March. So it's fairly strong. Ahmedabad is our home market. It is not as big as a Bangalore market, but this is not a small market either. 40% of 800 means almost like 300 plus crores coming from Ahmedabad is a decent number, but we see a lot of scope still. I don't think we are deep enough in any of these two markets. We see a lot of scope. I mean, we've got 3-4 projects going in each of these markets in a significant way, while Bangalore has a potential of at least having 12 to 15 projects going on at any one point in time. And quite a few developers have shown that in the past, and we clearly, in our own assessment, think that this kind of a depth is possible and doable for a brand like us. Similar is the case with Ahmedabad. We think we are still on the surface and there is enough depth to be explored further. So market sizing point of view, both the cities are fairly good. They are doing very good. Like Ahmedabad has quite a few triggers. For example, GIFT is happening, outside investment is coming, urbanization in a more systematic way is coming, quality of land being made available from town planning point of view is one of the finest in the whole country, and hence there are quite a few kind of tailwinds. One important thing which happened in Ahmedabad market is that the circle rates or the reference circle rates for properties have been doubled in one shot across the board. Not that this has totally taken away the problem for organized players like us who don't deal in cash at all and it's all about check transactions. But this definitely has helped people like us further. There's the component of transaction in the grey market that should go down dramatically. So that is one more boost which has come to people like us, and the constraint has gone down to that extent.
Right. And generally in these markets, do you see investor demand picking up? And I'm asking this because we've been reading a lot about rents shooting up in Bangalore especially. So what is the status there?
See, investors and rentals actually represent two very different set of customers. When the rentals are increasing, basically that means that investor-held inventory is actually going down and end consumption is increasing, which is a great news for us. When the rentals are increasing, this means that the consumption is high, and on ground there is a shortage of houses. That is all important. In fact, when it comes to investors, it's the other way around. If investors are coming back and investing a lot of money, resulting into stagnant rentals or rentals even going down that we've seen in the past couple of times, that is a dangerous situation of oversupply, which we should avoid at all the times. Players like us who have a clean business model, they normally will not prefer, and actually they can't afford to have a very large investor base. Investors in India come with a bag of money which is of multiple colors, which does not suit us, and we, broadly speaking, rely and depend upon non-investors and consumers. Our customer mix clearly states that our reliance, dependence, and our relevance to investors is very low. but end consumer we make a lot of sales. So that's why we sell so much of our inventory and so much of the portion of our sales goes towards direct sales and people who are just word of mouth and digital, etc. They make so much of sales to us. Maybe more than 80 to 90% of our sales is happening to either a second home buyer or the first home buyer, and that is the market which is more sustainable. Less prone to peaks and troughs, and that is where we are, and that's how it is spanning. Also, we don't really depend on investors. In general, also, we don't see investors coming into built-up properties in any significant way. Most of the action that we've been seeing and we are expecting to see in the coming few months and quarters is a market which is driven primarily by consumption and consumption. And increase in rental basically indicates towards that healthy situation that a good developer will expect to have.
Okay, all right. And just one last question that I have is the collections this year have been almost similar to the last year collections, but the sales have gone up by 30%. So is there any particular reason for that?
In a way, it depends upon the launch timelines and the initial collection, etc., etc. Now, Ankit, you want to say something about this?
Yeah, so if you were to look at the trend, we had in FY21 a pre-sales of 500 crores, then in FY22 600 crores, and FY23 now at 800 crores. So overall collections do catch up. Collections get caught up with lag. It will not happen that whatever is your pre-sales same will be the collection. So it will happen.
The question is that they should possibly have increased to a greater extent, so to say, which is a valid question. But we have our targets of collections based on the actual launches, the timeline of launches, and then the first milestone and the second milestone, third milestone, etc. The way we have launched and the sequence of the same, like the 3 major launches that we had towards the second half, and more like the last couple of months of the financial year, they just got sold, we get 10%, and then the collections kind of speed up. So this is a very normal trend. This is a function of when and how much was launched and sold. Accordingly, we planned out the collections, and collections have come out that way. So no big kind of anxiety on that. If we are segmented 600 crores and thereabouts, I think this will then mean that this year should be a better year.
All right. I have one more question if I'm permitted to ask.
Sure.
Yeah. So, the Bangalore launch that happened this year, both of them got sold out pretty quickly. What are you doing exactly in terms of, having such a phenomenal response? And, similarly, recently there was a project by DLF in NCR which was in news which sold, 8,000 crores in a day, a couple of days. So, what is generally happening and how, what is the consumer psyche when such phenomenal launches happen in 2 different markets? So, I just wanted your understanding or response on this.
It's a question which is asked multiple times. We have not only done this in Bangalore 2 times, as you very rightly said, we also did it in Ahmedabad in case of Fruits of Life. And before that, even during COVID, when we sold for a phase 1 and phase 2 and phase 3, exactly in the middle of COVID, it got the same or similar kind of response, almost unbelievable under the circumstances. So, but my understanding of the situation is that, of course, macros and markets play an important role. Customer psyche, preferences, and their kind of enthusiasm plays a very important role in all this. But having said that, below the surface are quite a few triggers, one of them being the product itself, the brand itself, and also the way you package yourself. A plotting scheme is a plotting scheme is a plotting scheme where you buy a piece of land and someday you hope to build your own home and stay there. And you see that the markets might become more expensive and it's better to buy your land now and build the house when you want it to. This is one of the examples of the launches that we are talking about. But then what all does it entail? What kind of amenities? What kind of designs? What kind of, layouts, plans, specifications And what is your credential? I mean, have you really delivered the kind of thing that you're talking about? Making 3D is one part of it, but can you back it up with something which is delivered on ground? So design is one, impressing is another, but then having the track record and showing on ground is one more important aspect. Your brand is another. Your place is another. The way you source your land is another important aspect. So it's a bundle of so many things and so many boxes to be checked right. And I'm very happy that the team here has checked most of the boxes in all these 3-4 major successes that we saw in the last few launches that Arvind did. I think we came out with the great product. We sourced the land well. We got the timings right. We got the pricing right. We got the product right in terms of its design. We got the specifications right. So if I claim, for example, I'm just dwelling a little more on this because I think it's a great question to ask, is that if I were to claim that in the entire township, if there are 10 kilometers of roads to be developed, they'll be all reinforced concrete roads. Or I will have a clubhouse which will measure more than 40 to 50,000 square feet. Or I will have this, I will have that, I will have a golf which will be not difficult to maintain, not too big to be handled by the residents later. At the same time, it will give you an ambience, it will give you fun, it will give you leisure. Now, all those packaging and positioning matter. Possibly we've done few things right on those, rather most of the things right on those, and that's what we have been doing. Plus, it has been magnified by the fact that we deliver such projects not in Bangalore but in Ahmedabad on a very large scale, multiple times, and those actual images are shown, are experienced by the consumers, and that creates a great amount of echo and possibility of redoing and replicating the same in a different market and different environment. So brand, positioning, track record, product, design, I mean, all these things have to make sense to create a success like this.
Okay, all the best for the future, and thank you so much for answering my questions.
Thank you.
Thank you. The next question is from the line of Forum Makin from JHP Securities. Kindly proceed.
Hello, sir. So when we say that we are going to launch projects worth 2,000 crores, does that mean that it's equal to the yet to be launched, the figure given in the estimated operating cash flow in the yet to be launched line? Does that add up to, that adds up to 2,000 crores? So is that what we are talking about?
Yes, we are talking about yet to be launched and including the additional phases which are committed, so to say. For example, if we have acquired a project with a 40 acre with a 400 crore top line potential, we are in the process of diligence for the balance phase of that project. So overall, the number represents primarily in the yet to be launched phase, as well as marginally the planned acquisition for those projects.
Okay.
So yeah, in a way it is a sum total of projects which are yet to be launched and hitting the market, including projects and the phases which are yet to be launched or projects which are coming afresh.
Right. And this is apart from the 1,000 crore investment on the platform too, right?
Sorry, your question. If you could repeat your question.
This is apart from the 1,000 crore investment for the platform too, right?
No, that is investment. This is the top line from the new launches. So obviously it's a consequence of investments that we do. So a 1,000 crore investment will give us a top line potential of around 4,000 to 5,000 crores. Out of this total 4,000, 5,000 crore top line, we're talking about almost like 2,000, less than 2,000, coming as top line potential from the launches we are planning from part of the total 1,000 crore rupee investment. 1,000 will be 4,000, this is 2,000 we're talking about, obviously it's part of that investment and it's result of that investment.
Oh, okay. Okay. And what is the kind of collection period that we can expect from this launches?
Cash flows, I mean, we know that if you're talking about free cash flows, that's one important number, and we just discussed about that. We had little more than 200 crores of operating cash flow, free cash flows that the business generated. And the idea is that with increased level of activity, increased level of launches, and accordingly collections, etc., this year should be better than the last year on free cash flow, those years.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Ritvik Sheth from One Up Financial. Kindly proceed.
Yeah, thank you for the follow-up. Sir, in this launch projects and in this business development, what would be the split between our own projects and the projects that we would acquire in the HDFC platform? Would we have any sense on that?
We can quickly add up that number for you, at least in the sense of own versus the platform. Just give us 30 seconds.
Sure. And so I have one final question as you pull this up. Last 5 years we've gone from 200 odd crores to 800 crores as of FY23. What is the vision for the next 3 to 5 years for the company? Where would we like it to take up? Because as I see, FY24 would be the highest ever in terms of business development for us, and almost 2x of what inventory we have from ongoing and upcoming projects. So it looks like that we are setting us up ourselves for something very big FY24-25 onwards. So we wanted to pick your brains. Where do we see ourselves in the next 3 to 5 years from current base? Yeah. Hello. Hello. Hello.
Excuse me, this is the operator, the management line. Hello.
Sure. Yeah. So sorry, I mean, it was on mute. So it's difficult to make any specific forward-looking statement, but at the same time, we have always been talking about a trajectory, and the trajectory can be expressed the best way in the form of growth that we have achieved in the past 4-5 years. Fortunately, there's a great track record, and we've been doing a CAGR of around 40% thereabouts on most of the parameters. We always have a target of growth in parameters like top line, EBITDA, PAT, etc., growing at a rate of 25 to 30 odd percent. So what I can again reaffirm is our commitment or our endeavor rather to continue to achieve this growth rate of around 30% going forward in the next 2 to 3 years. And obviously, once that is achieved, most of the numbers will fall in place in proportion to that.
Sure. Okay. And if you could just give that split between own projects and HDFC platform projects for.
So in the 2000 or thereabouts crores that we just talked about 60% should come from our own projects, and 45% should be coming from the platform investments.
Okay. And for the BD, for the business development for FY24?
See, 1,000 crore BD will mean that, 900 crore platform in total required 600 crores to come from HDFC. Part of it is already deployed, maybe 400, 450 is still to be kind of committed, which is still to be announced. So if 400 to 450 crore is to be coming from HDFC share in the platform, the balance 500 plus crores should be coming from us, whether it is part of the platform or it is independent project taken up by us. That's immaterial. So broadly speaking, it should be coming from our share and HDFC to that extent in these proportions. Okay. Ankit, you want to clarify this number?
Yeah. So approximately out of 1,000 crore investment, 800 crore platform investment will come in,
So 800 means we will invest how much? 33% of that. So 800 will mean 250 crores coming from us and 550 from the platform.
Right.
And from 1,200 pure R investment. So that's exactly the same number. That 450 will come from us as an investment proportion in the overall balance sheet, and 450 will come from SDFC. So overall investment is happening in this proportion. But otherwise, 800 crores is happening through the platform route, and 200 crores will happen purely from our side without any kind of partnership with the platform. Purely on.
Right. Got it. Sure, sir. This is very helpful. All the best and thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Kamal Singhal for closing comments.
So great. Thank you very much for being part of this call. We've had an exciting last year and looking forward to even more excitement as we move forward into the new year. There are quite a few reasons to feel satisfied. But at the same time, we know that the challenges ahead are bigger and there are bigger milestones to be achieved, and hence we need to put together a team and an effort which makes it all happen. Somebody asked a very interesting question during the call about redevelopment in Mumbai and MMR. I think that's one important opportunity which exists for an organized branded player where the residents tend to, for example, trust more of those players in a situation like this, having got the experiences of various kinds in the market. So that's one opportunity, for example, which we are very excited about, and we are putting efforts to see if we could do something really exciting there in that space. But having said that, we are aware as a company of the challenges. We know the strengths. We know the kind of headwinds that we possibly could face in micro and macro environments. We know the tailwinds that we've got already in terms of our track record, in terms of great products, a great team which is already in place, and also the team which needs to be expanded from here onwards for an orbital change that we're all looking forward to. And with all these awareness and the kind of support and commitment that the promoters have shown in this business for the last few years, I mean, this is the only business in the entire group in the last 10 years that promoters have put money twice, rather thrice. And key management personnel, including myself, have put in significant money into the company. So I think they're all poised to take the next leap, next change orbitally in terms of size, scale, and the objectives that are set for our company are, I mean, we are very well poised to strive and endeavor to achieve all those things. Thank you very much for your time, and look forward to meeting you again after some time. Thank you.
Thank you. On behalf of Arvind SmartSpaces Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.